Investing has always been surrounded by an air of mystery. For decades, it has been portrayed as a high-stakes game reserved for the wealthy elite or financial professionals in suits shouting on stock exchange floors. This perception, combined with persistent myths, creates a mental barrier that prevents millions of people from taking their first step into the world of investing. These myths aren't just harmless misunderstandings. They're powerful deterrents that keep ordinary individuals stuck in cycles of saving and spending, never realizing the true potential of their money. The good news is that most of these myths are outdated, oversimplified, or entirely false. Once you see past them, you'll realize that investing is neither as risky nor as exclusive as you might think. In fact, it's one of the most accessible and effective ways to build lasting wealth. Today, we're going to uncover the truth behind these misconceptions, offering clear, actionable insights to help you take control of your financial future. Remember, understanding these myths isn't just about avoiding mistakes. It's about unlocking opportunities to create a better, more secure life for yourself and your loved ones. Myth 1. You need to be rich to invest. This myth is one of the oldest and most persistent. For decades, investing was indeed a game played by the wealthy, requiring significant sums of money, exclusive access to brokers, and insider knowledge. But the financial world has evolved. Thanks to advancements in technology, the barriers that once kept ordinary people out of the market have crumbled. Today, investing is more accessible than ever before, regardless of your income level. Consider the rise of platforms like Robinhood, Stash, and Acorns. These apps allow you to start investing with as little as $1. You no longer need to buy entire shares of expensive stocks like Apple or Google. Fractional shares let you invest whatever amount you can afford. For example, if a single share of Tesla costs $1,200, you can invest $50 and still own a portion of the company. This means anyone with a smartphone and a few spare dollars can start building a portfolio. But accessibility is just one part of the equation. The real power of investing lies in compounding, earning returns on both your initial investment and the returns it generates over time. Let's break it down. Imagine you invest $100 a month starting at age 25, earning an average annual return of 8%. By the time you're 65, you'll have over $300,000, even though you only contributed $48,000 out of pocket. That's the magic of compounding. Starting small doesn't just make investing possible, it makes it incredibly powerful. The longer your money has to grow, the larger your returns will be. So, the next time you hear someone say, "I'll start investing when I'm rich," remember this. Wealth is a result of investing, not a prerequisite for it. Even if all you can spare is the price of a cup of coffee each week, that's enough to start building your financial future. Myth 2. Investing is just gambling. Many people equate investing with gambling, believing it's a high-risk game of chance where you're just as likely to lose as you are to win. This myth often stems from sensationalized stories of market crashes and people losing their life savings. While it's true that investing carries risks, it's a far cry from the unpredictability of gambling. When you gamble, you're betting against the odds. In a casino, the house always has the edge, and the longer you play, the more likely you are to lose. Investing, on the other hand, is about owning real assets, stocks, bonds, real estate, that generate value over time. For example, when you buy a share of stock, you're purchasing a piece of a company. If that company grows its revenues, expands its operations, or innovates, the value of your investment increases. Let's take a historical example. Over the past century, the US stock market has delivered an average annual return of around 10%. That includes major events like the Great Depression, World War II, and the 2008 financial crisis. Even with these downturns, the market has consistently recovered and grown over the long term. This isn't luck. It's the result of economic growth, technological advancement, and the resilience of businesses. To further reduce risk, you can diversify your investments. By spreading your money across different industries, asset classes, and geographic regions, you minimize the impact of any single loss. For instance, If one sector, like energy, experiences a downturn, other sectors, like technology or healthcare, might still perform well. Diversification is your safety net, something gambling can never offer. Myth 3. You must time the market perfectly. The idea of timing the market, buying low and selling high, sounds logical, but in reality, it's nearly impossible to execute consistently. Even professional investors with decades of experience struggle to predict market movements accurately. Yet this myth persists, leading many people to delay investing because they're waiting for the perfect moment. The truth is, the perfect moment rarely exists. Markets are unpredictable in the short term, influenced by everything from economic data to global events, and even investor emotions. Trying to time your entry perfectly often results in missed opportunities. Consider this. If you had invested in the S&P 500 from 2000 to 2020, your average annual return would have been around 6%. But if you missed just the 10 best performing days during that period, your return would drop to a mere 2.4%. Those few days make a massive difference, and they're impossible to predict. Instead of trying to time the market, adopt a dollar-cost averaging strategy. This approach involves investing a fixed amount at regular intervals, regardless of market conditions. For example, if you invest $500 a month, you'll automatically buy more shares when prices are low and fewer when prices are high. Over time, this smooths out the ups and downs of the market and ensures consistent progress. Remember, the key to successful investing isn't timing, it's time. The longer you stay invested, the greater your potential for growth. Markets may fluctuate in the short term, but over the long run, they trend upward. Myth 4. You need to be a financial expert. Many people avoid investing because they feel it's too complex or that they lack the expertise to make good decisions. They imagine successful investors as mathematical geniuses poring over financial statements and market data. While there are professionals who do this, the truth is, you don't need to be a financial wizard to succeed in investing. For most people, simple strategies work best. Index funds and exchange-traded funds, ETFs, are excellent examples. These funds pool money from many investors to buy a diversified portfolio of stocks or bonds. By investing in an S&P 500 index fund, for instance, you're effectively buying a small piece of 500 of the largest companies in the US. This diversification reduces risk and simplifies the process. You don't have to research individual stocks or time the market. Even Warren Buffett, one of the greatest investors of all time, advises most people to stick with low-cost index funds. They outperform most actively managed funds over the long term, thanks to their lower fees and broad exposure. This expanded version provides greater depth, actionable examples, and detailed explanations. If you'd like me to continue or focus on a specific section, let me know. Myth 5. You can't invest until you're debt-free. It's common to hear that you shouldn't invest until all your debt is paid off. While it's true that high-interest debt, like credit card balances, should be addressed first, not all debt is bad. Low-interest debt, such as student loans or mortgages, doesn't need to stop you from investing. Consider this. If your student loan interest rate is 4% and the stock market historically returns 7 to 10% annually, you could come out ahead by investing while making minimum loan payments. The opportunity cost of waiting is often greater than the benefit of becoming completely debt-free first. A balanced approach works best. Allocate a portion of your income to pay down high-interest debt while investing the rest. This strategy allows you to build wealth and reduce liabilities simultaneously. By leveraging time and compounding, you can create a future where your investments grow faster than your debts shrink. Myth 6. Investing is too risky. Risk is often cited as the primary reason people avoid investing. But here's the irony. Avoiding investments is one of the riskiest financial decisions you can make. Why? Inflation. Inflation erodes the purchasing power of your money over time. If you leave your savings in a low-interest account earning 1%, but inflation is 3%, you're effectively losing 2% of your money's value every year. In contrast, investments like stocks, bonds, and real estate have the potential to outpace inflation and grow your wealth. The key to managing risk is diversification. By spreading your money across various asset classes, sectors, and geographies, you reduce the impact of any single loss. For example, when stocks decline, bonds or real estate may perform well, balancing your portfolio. Risk can't be eliminated entirely, but it can be controlled. With a long-term mindset, the rewards far outweigh the risks. Myth 7. It's too late to start. This myth is particularly common among older individuals who feel they've missed their chance. While starting early is ideal, it's never too late to invest. Even small contributions can grow significantly over time. For example, someone in their 50s who invests $500 a month for 15 years can still accumulate over $150,000 with an 8% annual return. Tax-advantaged accounts like 400 and Omnix and IRAs are especially helpful, as they allow you to save on taxes while your money grows. Additionally, many retirement plans offer catch-up contributions for those over 50, letting you save even more. The key is to take action immediately. Every day you delay is a missed opportunity to grow your wealth. Conclusion: the myths surrounding investing are nothing more than barriers to your financial success. They create fear and confusion where there should be confidence and clarity. But now you know the truth. Investing isn't reserved for the wealthy, the lucky, or the experts. It's a tool for anyone who wants to take control of their financial future. Start where you are. Use what you have. Begin today. The sooner you invest, the sooner your money starts working for you, building the life you've always dreamed of. Remember, the biggest risk isn't investing. It's doing nothing. Don't let these myths hold you back any longer.